Hey guys, welcome back to my channel. In this video, we are going to discuss on whether you should invest in penny stocks. Is it worth it? And what are some of the mistakes that you might do if you are considering investing in penny stocks? So let's get started. So first of all, let us understand what are penny stocks. To give a very generalized explanation, they are basically stocks that trade at a lower price and have a lower market capitalization. Basically, small sized companies which are trading at a lower price. Now, a lot of people like to consider an absolute price. For example, stocks which are trading less than 5 rupees or 10 rupees as penny stocks. However, to generalize, stocks that are trading at a lower price and which are usually small in size. Now, if you're considering investing in penny stocks, there is a concept of penny mindset that you should understand, which is very important. I'll explain you with an example. So, say for example, you have 10,000 rupees to invest, and you have an option to invest in a blue chip stock. Say for example, which is trading at 500 rupees per share. So, if you are investing 10,000 rupees, that means you can buy a quantity of 20 shares. So, when I say blue chip stock, I mean a well-established company which is growing consistently, is a market leader, and has already proved its value in the market. And then you might have another option of investing in a penny stock. Let's take an example, any stock which is trading at about 5 rupees a share. So in that case, if you are investing 10,000 rupees, you will be able to buy 2,000 shares of that particular company. Now, as a beginner, we often fall for this trap that we feel we can buy a lot more quantity with the same amount of money. So the second option is much better, or at least it is more attractive. However, in the larger picture, that is not a good choice, and I'll explain you why. For that, let's try to understand the percentage price trap. So say for example, you are planning to invest in a penny stock which is currently trading at 5 rupees, and you are expecting the price to rise to up to 7 rupees, which means you are expecting a return of about 40%. This is just an example. Now here the change in price is just 2 rupees, right? Let's take one more case. So say in the second case, we are considering a blue chip stock which is trading at about 500 rupees a share. Now expecting the same return of 40%, you should expect the price to go up to 700 rupees, right? So in this case, the change in price is 200 rupees. So now if you closely observe both the cases, the return in terms of percentage remains the same, but the change in price, the absolute value, varies largely. Due to this, our mind thinks that case 1 is much easier or lucrative option, and you think that it is easier to make money in case 1 because you think the price just has to change by 2 rupees and you will make 40% return. However, this is entirely not true. It's just that your perception towards case 1 is easy. However, in reality, it is much more difficult to make money in penny stocks because they keep on falling further, at least in most cases. So in case 1, your perception is that it is easier to make money. However, the reality is much difficult, and as we proceed in this video, I'll explain you why. And in the second case, your perception is hard. You think that the price has to move by 200 rupees, which is a lot difficult. However, most blue chip stocks, you will see they were already trading at all-time high prices a couple of years back, and currently also they are trading at all-time high prices, and they might continue to grow. Our mind tricks us to believe that in this case it is difficult to make money. However, it is not. In fact, in most cases, more people have made money by investing in blue chip stocks rather than penny stocks. So here the perception is hard. However, the reality is much different. So just because a stock is quoting at 5 rupees, that doesn't make it cheap at all. And this valid statement puts it right that many penny stocks are traded so cheaply because the businesses behind them aren't worth much more than that. So those penny stocks are cheap because maybe that is what they are worth it. They are trading at cheap because maybe that is what actually they are valued. Let's understand this better by taking an example. So this is a chart of what most penny stocks will look like, something like this. So say if a penny stock is currently quoting at 5 rupees, maybe at some point of time it was trading at 100 rupees a share, then it fell to 50 rupees. Maybe you thought it is now cheap, but it fell further to 20 rupees. Again you thought it is cheap, you bought it. Again now it fell to 10 rupees. You thought it is cheap, and it continues falling, and maybe it is currently quoting at 5 rupees, and now you are considering investing in this stock. There is a very high probability that you will not be able to make money in this case. I'm using the word probability and not possibility. Obviously, it is possible that this price can go back to where it was and you can make 10 times return on your money. All that is possible. I am saying that there is very less probability of this happening, and if you look at charts of various penny stocks, you will come to the same conclusion. Let's take the other case. So say if you are considering investing in a blue chip stock which is currently quoting at 500 rupees a share, there are chances that it was earlier quoting at much lesser prices. In this example, it went from 5 rupees to 10 rupees, and you might think it is expensive at 10 rupees because earlier it was quoting at 5 rupees. Then it went up to 50 rupees. You still think that it is expensive. Then it goes up to 100 rupees. You still think this is expensive. Then it goes up to 500 rupees. You still think it is expensive. But the reality is, as long as the company continues to grow and their earnings are growing, the price usually reflects it in the long term, and it will continue to rise as long as the company is doing well. I am again not generalizing it. This is what happens in most cases. Obviously, there are exceptions. And what I'm trying to say is that if you are considering investing in penny stocks, then you should know the risks that are associated with it. So if you talk about the risks that are associated with penny stocks, it is possible that you might not have a lot of information in case if the company is very tiny and just starting out, which also means lack of financial data. And in these cases, usually you will see that penny stocks are hugely volatile, which means on some days you might see they are hitting upper circuits, on some days lower circuits, and the price is very volatile, due to which their performance will vary over time, which leads to inconsistent past performance. Because of all of this, it is very difficult to predict whether the company will do well in future, and the growth prospects in this case are also uncertain. Also, one very important point to note, such stocks are easier to manipulate and operate, due to which many scams and irregularities happen around penny stocks, which are small sized companies. Because as retail investors, we don't have enough information about these companies, and they might eventually fall prey to insider trading and pump and dump schemes, which you may have heard of. I'll make a separate video on how all that takes place, but you should understand that there are various risks that are involved while investing in penny stocks. Now, by no chance am I trying to say that penny stocks are completely bad and you should avoid it. I'm just putting out my perspective here, and it is very much possible, and in certain cases people have made money in penny stock, but more people have also lost money in penny stock. So that is what you need to understand. So we talked about the dark side. Let's also talk about the good side, if there is any. So here there are two exceptions which I want to address, in which you might consider investing in so-called penny stocks. The first case is what I call fallen angels. So companies which were trading at relatively higher market cap earlier, however, due to irregularities and poor performance, eventually they lost a lot of their value. Say they have corrected about 90% and had a huge fall from their all-time high. However, there is something intrinsic change that is going on in the company. For example, the management is constantly trying to reduce the debt, some change in the vision, or they are trying to move towards a sustainable and profitable business. Some intrinsic change in the company which might bring around a turnaround story. However, such cases are very hard to find, but it is possible. The other case, what I like to call promising newcomers. So these are small sized companies which haven't seen any bad fall as such, but they are in so early stage right now that it is difficult to predict whether they'll sustain or not because of the big market leaders. However, if it is a new company which is bringing in more R&D, innovation, and solving a bigger problem which is already not present in the system, and they are able to sustain and grow, in that case they might see an immense growth, because every large company that you see was once sized small as well, and they eventually made their way up there by performing well consistently. But that is what you can say. However, finding such promising newcomers is difficult because there is already a lot of competition among businesses, and it is difficult for a newcomer to survive. But there is definitely a possibility that it might grow from you. That was it from this video. I hope you enjoyed and learned something new. If you liked this video, make sure to hit the like button. If you have not subscribed yet, hit the subscribe button and share this video with your friends and family as well. Thank you so much for watching. Bye.